afternoon, I'm Zach Ryan and I work in the investment management team, and I'm going to give you a brief overview of this week's market summary. We had a miserable start to the week as global equity markets fell after the weekend, which saw Middle East tensions escalate. However, Iran's retaliation was probably the best possible outcome for global equity markets. It appeared that domestic demands for revenge, but with no casualties, meant there was no need for the US to respond. As a result, the week ended as though nothing had happened, with most of the major global equity markets returning to their pre-Iran crisis levels, while the price of a barrel of Brent crude fell back to $65 from nearly $70. This highlights that sometimes there's nothing to fear but fear itself, and it's important not to get wrapped up in the headlines. It was implied that we're on the brink of an all-out war in the Middle East and there would be an imminent oil shock that would push the global economy into a recession. However, there have been plenty of reasons to remain calm from a macro growth perspective. For example, monetary policy remains a key driver for equity markets, and the world's major central banks have made it clear that interest rates will remain low. As a result, any weakness in global equity markets is currently seen as a buying opportunity rather than a reason for panic. This week's data releases have been relatively light and mixed. US non-manufacturing data came in better than expected, with a reading of 55, while US non-farm payrolls disappointed slightly, coupled with a small downward revision to the previous 2 months. The unemployment rate was unchanged at 3.5%, while average wage growth slowed from 3.1 to 2.9%. Now that's all from me this week, and don't forget, if you haven't already, you can also read a more detailed insight into matters affecting the markets in the email.